Now, before we get into some of the different pieces of housing, industrial production, we just want to look at what's happening with the debt ceiling. So as those that have been paying attention, they signed a stopgap that increases the debt ceiling essentially into December. But the question is going to be, what happens from that point forward? So the borrowing ability, as it continues to get stressed as you get into December 1st, but then the cash balances dwindle down. And the question will be, how close do we get, and what is going to be the negotiation? Because they just kicked the can a month. And the hope is that they come to some sort of agreement. It's going to be a negotiation tool where you see how close we get as we get to the end of December, what that is going to look like. And again, do we default? I'm going to say no. With a hard stop, we will not, because they will come, they'll push us to the brink, but they won't get us over the edge. And that's why you see some of these fears in terms of 20-year, with the poor 20-year auction, as some of this pressure mounts. And you can see that we start to get really concerned and again, this is just an estimate from Oxford Economics of just what that cash balance will look like. And that's why we're going to have to see some of this start to level off as we get into really the middle of December into the end of the year. Now, when you look at what rates are doing, rates continue to remain low, but we're starting to see rates creep back up. The 30-year mortgage is back over 3%. You're starting to see some of these pressure points, especially on the long end of the curve. When you look at duration, because you have these underlying fears coming back in, you do have this acceleration of inflation. And this is just reiterating something that we've shown on apartment rent for recent movers on apartmentlist.com. You can see that it leads by five months as just off the charts. And that's going to continue to pull up that CPI primary and owner's equivalent rent, which is that 40 to 43% of CPI, again, driving that. So even as we have those reopening numbers coming down, this is going to put that underlying or that underlying support on inflation coming through over the next few months. But then when you look at just what's happening on buying conditions for vehicles, according to the University of Michigan, worst ever, as used car prices shifted back up in October. So far, we've now hit a new record after dipping in September, sending us back to new all-time highs. Again, all of that is just creating more and more issues on the inflation side. But then when you look at home builder confidence and housing starts, home builder confidence has gotten a little bit better because, again, they're still seeing this demand. Now, there's balking at the price, and you're just not getting bidding wars, but you're still getting a bid that is $200,000 above what it previously was. So it's just you're not getting people coming in, it being listed $150,000 above previous, and then clearing $300,000 above. You're starting to get a little bit closer to the metric. But then when you look at housing starts, those remain fairly fixed at this point, at this fairly fixed level. But we have to look at what types of housing starts. So starts and permits have come down a bit. Starts have normalized. September housing starts weaker at negative 1.6% versus the estimate of negative 0.2%. So then when you look at building permits, they were down 7.7% versus the estimate of 2.4%. So that's where you're seeing just some of this. Again, there's seasonality in this. There's a lot of these, some of these overhangs. But then when you look at total permits, they continue to be driven more by single family versus multifamily, as you see some of those normalizations. But they're still coming down as there's permits to work through. The housing starts to pick back up. And the question is going to be, how quickly do we see that come in? Because remember, I think it was 2 weeks ago, we said that 94% of builders have at least one shortage. That's at least one equipment shortage. That's not including labor, just one physical raw material shortage, which again is just going to limit the amount of activity. Now, housing completions continue to fall. Overall, blue, which is the lowest since August 2020, but multifamily, which is the lowest since September 2019. So you're seeing completions come down. And it was, remember, because a lot of these sales are pre-construction. So you're seeing the most ever sales pre-construction because a lot of these builders are like, look, I'm not going to start that house until I've already sold it and locked in not only how much I'm getting from it, how much I'm making, but then locking in my raw material costs and creating that spread due to the elevated level of raw material pricing. So then when you look at, some of the recent data, as we talked last week on the U.S. Empire State business conditions, as we discussed in the Friday FSC show, you can see here that business conditions have continued to get better. But when you look at prices paid are starting to come back up. When you look at prices paid, prices received, we continue to see some of these diversifications as delivery times got worse again in the U.S. Empire Regional Fed. But when you look at all of this on an aggregate, U.S. industrial production came down. And here you can see we're now back below where we were, back below pre-COVID levels. And you're starting to see some of this pressure coming down as U.S. capacity utilization getting worse. The expectation was for 76.4%, came in at 75.2%. So again, more of that sluggishness and slowdown in general. But when you look at September Zillow Home Value Index, back to a new all-time high, and this is looking at it even going back through the 06-07 run, just showing you how white hot things are still active are in this metric, which is why when you start layering in where some of these things are, then you factor in industrial production weaker in September at negative 0.3% versus a positive 0.2%. Worst monthly decline since February's minus 3%. Factory production came in at negative 0.7% versus the 0.4% prior. So you're seeing a lot of these slowdowns because this is obviously GDP. When you look at the GDP calc, you have to look at all of these different metrics to say, okay, well, where's housing? Where is industrial production? So then, when you think about the C plus I, that I side, the investment side is going to go off of, well, is production going up or down? Do I need to invest in what's going on? Is the consumer strong? So should I produce more? Is the X minus Y or the exports minus imports or imports going up or exports going up? So I have to increase production. Again, a lot of these are weighing on what that calculation looks like, which is why we're starting to see these lower bids coming in for Q3 and really continuing into Q4. Now, as we said, with retail sales less auto and gas, you can see here that they still remain elevated, and even though value has gone up, that's where the value versus volume. So value's gone up, and they've come up to meet that. But what is going to be the overhang going forward? Which is then you look at some of these PPI. So PPI airline passenger services has come down. That is now going to start to creep back up. And this is one of the biggest what dropped that PPI value. When we look at, and we spoke about it on Friday, how we saw a drop in producer price index. And again, a drop below we missed estimates, but a lot of it was actually driven by airline passenger services. So you're starting to see some of these shifts in general. And now we're starting to see inflation catch up, which again is going to put that overhang when you look at the consumer, what inflation looks like, what housing is doing, what industrial production is doing. And then when we project out using leading indicators, Q4 doesn't look any better than Q3. It looks a bit worse. So it's realistically, I think we're going to bump along the bottom of this, let's just say below 1% growth as we kind of, let's just say limp out of 2021. And then as we've talked about so many times, the fiscal pressure or the fiscal drag on all of that stimulus in 2020 and the beginning of 2021 is going to create this big overhang where we could actually start to see some contraction in the first half of 2022, which again is going to be something to talk about as we get October data sets. And are we right with some of the slowdown continuing? Are we starting to see some of this pivot back up as we head into November? But I just think that you're going to see a pause for a lot of this as some concerns remain and inflation remains elevated as we head into the holiday season, and you'll see things slow down. So now that we've kind of wrapped up the US, we now want to pivot and look at what's happening in Europe and how have things changed, especially when we start looking at inflation and what that's going to do to the underlying economy in that region.